Imagine losing tens of thousands of dollars, not because the market crashed, but because of decisions you didn't even realize you were making. Imagine putting $10,000 in the stock market, expecting it to grow, only to check 10 years later and see it worth barely $15,000, while the same investment for someone else became $40,000. Why does this happen? Why do most people lose, even when the market itself grows year after year? Today, I'm going to show you how the stock market really works, step by step. We'll explore real numbers, real mistakes, and real strategies that can make or break your financial future. Stick around by the end. You'll understand what most investors never do. And you'll see exactly how to put the odds in your favor. And if you want more deep insights like this, hit subscribe now. IT could change how you see money forever. The stock market is the ultimate wealth-building machine, but it's not magic. It's math, psychology, and history combined. The S&P 500 has returned an average of 10.54% per year since 1957. That means a $10,000 investment back then would be worth over $8 million today. But most investors don't see that. According to Dalbar, the average investor underperforms the market by 6% per year. That's not small. That's not small. It's the difference between financial freedom and watching your money slowly disappear. Why? Emotional decisions, poor timing, lack of knowledge, and fees. A stock is ownership in a company. If you buy one share of Apple, you own a tiny piece of that company. You benefit from price appreciation and dividends. But if the company fails, you lose. 100 shares of Apple purchased in 2005 at $10 per share, adjusted for splits, would have been worth over $35,000 by 2020 if you held them. Many investors sold along the way, missing the gains. Stock prices move based on supply and demand, company performance, economic news, and investor sentiment. In March 2020, the S&P 500 dropped 34% in just 1 month due to COVID-19 panic. Investors who sold lost thousands, but those who held saw a full recovery by year's end. Dividends are overlooked but critical. Over the last century, dividends have contributed roughly 40% of total market returns. Reinvesting dividends compounds your wealth significantly. A $50,000 investment in Coca-Cola in 1980. Reinvesting dividends would be over $10 million by 2020. Without reinvesting, it would be $2 million. That's the power of compounding. The S&P 500 tracks 500 large companies. The Dow Jones Industrial Average tracks 30 major companies. NASDAQ Composite is tech-heavy. Understanding these helps gauge overall market trends and reduce guesswork. Fear and greed destroy returns. In 2008, investors panicked and sold at the bottom. A $100,000 portfolio fell to $60,000. But if held, it rebounded to $180,000 by 2013. Trying to time the market rarely works. Missing the 10 best days from 1990 to 2020 cut returns nearly in half. Staying invested beats guessing the top and bottom every time. High fees silently kill wealth. A 1% annual fee over 20 years reduces a portfolio by roughly 18%. On $500,000, that's $90,000 lost to fees. Putting all money in one stock is gambling. Even Amazon lost 50% of its value in some years. Diversification reduces risk and smooths returns. Psychological biases also affect results. Herd mentality makes investors buy what everyone else buys. Overconfidence makes people think they can beat the market consistently. Loss aversion makes people panic sell at minor losses. Many sold Tesla during early 2020 dips, missing 700% gains in a year. In the late 1990s, investors poured money into internet stocks without profits. Pets.com went from $11 to $0 in a year. Amazon survived, teaching us to focus on fundamentals. The collapse of Lehman Brothers in 2008 caused widespread panic. Many investors sold their holdings at a loss. Those who remained invested saw their portfolios recover fully by 2012 and 2013. A $50,000 investment in the S&P 500 in 2007 became $75,000 by 2013 after recovery. Warren Buffett focuses on value investing, long-term holding, and dividends. Berkshire Hathaway grew from $10,000 in 1965 to $400 million today per original $10,000 investment. The difference? Patience, discipline, and knowledge. One investor bought index funds in 2000, ignored crashes, and saw their portfolio grow 700% by 2020. Another bought tech stocks in 2000 but sold in panic in 2001, losing 50%. Decisions make the difference. Adopting a long-term perspective allows investors to ride out market volatility. Regularly investing a fixed amount, regardless of market conditions, smooths the impact of market fluctuations. Spreading investments across stocks, bonds, and real estate mitigates risk. A 60-40 portfolio versus 100% in tech reduces risk but maintains growth. Choosing low-cost funds and ETFs enhances long-term returns. Vanguard VOO and BlackRock IVV have expense ratios of 0.03% compared to over 1% for many mutual funds. Staying informed about financial markets and investment strategies is crucial. Books, online courses, and financial news provide valuable insights. Learning continuously, knowing your biases, and questioning every decision protects your wealth. Investing 70% in index funds, 20% in bonds, 10% in dividend-paying stocks, and adjusting yearly could turn $50,000 into over $300,000 over 20 years at 8% average annual return. What would you do in a 30% market crash? Panic sell or hold? A $100,000 portfolio drops to $70,000. Hold 5 years. Recover to $120,000. Panic sell? Stuck at $70,000. Numbers don't lie, patience wins. $10,000 invested in Tesla in 2019, held through 2020, was worth $70,000 by the end of the year. Sold early. Maybe $30,000. Decisions make the difference. The stock market builds wealth, but most lose because of human behavior, poor timing, fees, and lack of strategy. Focus on long-term, diversify, minimize fees, and educate yourself. Compounding, dividends, and discipline are your true allies. Starting early, staying disciplined, reinvesting dividends, and using low-cost, diversified investments can turn small amounts of money into significant wealth over decades. The difference between success and failure is not luck, it's strategy, discipline, and understanding. In 1929, the stock market crashed, leading to the Great Depression. The Dow Jones lost nearly 90% of its value over the next 3 years. Investors who panicked and sold lost decades of potential gains. Those who stayed invested gradually regained wealth. From 1987 to 1989, Black Monday occurred. The Dow dropped over 22% in a single day, but recovered within 2 years. A $50,000 investment left untouched grew to over $75,000. Patience pays more than panic. Investor A, investing $500 per month in the S&P 500 from 1990 to 2020, stayed fully invested through all crashes. Their total investment of $180,000 grew to over $1.2 million. Investor B, panicking during downturns, ended up with just $450,000. Same initial investment, drastically different outcomes. Even famous investors face psychological pressures. Warren Buffett says, "Be fearful when others are greedy, and greedy when others are fearful." He bought during downturns, like American Express in the 1960s and banks after 2008, profiting enormously when markets recovered. During the 2008 crisis, the S&P 500 lost 38%. Selling would lock in a $38,000 loss on a $100,000 portfolio. Holding would have grown it to $150,000 by 2013. Compounding works over time. $10,000 at 8% annual return grows to $21,589 in 10 years, $46,610 in 20 years. $100,626 in 30 years. Long-term investing beats short-term reactions. Diversification protects. Investor C in 2000 put all money in tech stocks, losing 60% by 2002. Investor D spread investments across sectors, losing only 20%. Risk management through diversification is critical. High fees are costly. $100,000 invested in a 1.5% fee mutual fund grows to $297,000 in 20 years at 8% returns. A 0.03% fee ETF grows to $466,000. That's $169,000 difference from fees alone. Fear of missing out drives mistakes. The dot-com bubble inflated stocks with no earnings to billions in value. Many investors bought at the peak and lost everything. Patience and analysis beat emotion. Dividends matter. $10,000 invested in Coca-Cola in 1980. Reinvesting dividends is worth over $1.5 million today. Without reinvestment, only $450,000. Dividends silently compound wealth. Success strategies: long-term investing, dollar-cost averaging, diversification, low fees. Reinvesting dividends, continuous learning. Invest $10,000 annually in an S&P 500 fund for 10 years. Total contributions, $100,000 at 8% return. Portfolio worth $148,000. Stop halfway and panic sell during downturn. Portfolio shrinks to $80,000. Consistency and discipline outperform short-term reactions. The stock market is not a lottery. Dividends, long-term thinking, and compounding.